Inflation is in check. The CPI number came out much less than expected of what Wall Street was expecting and sent stocks soaring to the moon. We saw all three major averages up big today, and we saw the 10-year yield drop below 4.5%. What does all this mean? Well, it means the bulls are running on Wall Street again. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and hot Scottsdale, Arizona. I'm assuming it's hot.
It's 78 degrees, you bonehead. For you, that's freaking, midsummer.
Yes, it's tropical. Yes,
yeah.
Very tropical out there. We have a very special guest with us today, though, to break down today's market action and tell us where you want to be for the rest of the year. Samantha LaDuc. She is the founder and president of LaDuc Trading out of Andover, Massachusetts. Samantha, welcome to Buy, Hold, Sell.
Thank you so much, gentlemen.
Absolutely. Well, we're
okay,
so happy.
Let's not say gentlemen too quickly, okay, Samantha? Let's do it.
All right.
Don't let the cart get before the horse.
There you go. Well, listen, Samantha, we got to start with you because the trading today, it was just complete. We just saw the bulls running, stocks just soared to the moon. Once the report came out at 8:30, we saw Dow futures jump over 300 points, and it was just all systems go all day long. And the feeling right now is that not only is the Fed not going to be hiking at the December meeting, they're likely not going to hike at all going forward, which is always going to be a bullish signal for the markets. But what's your take on all of this?
That has been my baseline bet since March 12th. So March 12th was Sunday before the futures market came out, and it was post Silicon Valley Bank fallout. And they, meaning Fed, Treasury, and White House, all came together and said, you get a car, you get a car, you get a car. Basically, we're going to backstop all of these unrealized Treasury losses from this potential bank run. And we're just going to put a stay of execution in all of your worries as it relates to stocks and equities from falling. And literally we digested a little bit back in March, and then we have been moving higher since. And my tweet literally on that day was, that's it. This is the implied Fed pause. They're going to ratchet down their hikes from here, and then they're going to stop. I don't see another hike after, this year. I don't see even a cut this year. I see Fed pause, and you buy the rumor of this Fed pause until they cut.
Well, Samantha, it was interesting today to see the odds of 25 basis cuts, a quarter percent, for all four Fed meetings next year with cuts. And, everybody's been waiting for, it's like, waiting for whatever to show up, Godot to show up. Yeah. Just with your LaDuc last name, I wanted to throw a little Godot in there, okay? The Godot has been the lag effect. And it was, I think you make a really good point about we used to have the mysterious Fed put, and then we have the actual Fed put for about 12 years. And then all of a sudden, people said, no, the Fed's done supporting the market. And then they came in with all guns blazing. And when Silicon Valley Bank, imploded, that meant other ones are going to go. And I think that was a really good call on your part, because in essence, now the emperor has no clothes, right? I'm just going to mix every metaphor I know.
Okay, and a play on terms.
Now they can't. Now they box themselves in.
So Fed is trapped, and that's been my mantra. Like I keep talking about this over and over and over again. But it is more than a Fed put. It's the Yellen Yahtzee. So the Yellen Yahtzee is all about this Treasury bond issuance. It's a big honking deal because the massive Treasury bond issuance that came in July 31st was the reason for the season in the gap down in both NASDAQ 100 and SPY on August 1st. It was massive. And it obviously continued to put a bid, not only in the dollar, but the 10-year, right? So as we had
Note to self, Yellen Yahtzee.
Yellen Yahtzee. So this is really, really important because Treasury issuance trumps the whole Fed put thing. Fiscal is basically not going down, which demands more bond issuance. So therefore, it's fiscal over Fed. It's Yellen Yahtzee over Fed put. I'm a firm believer in that. And now fast forward, we had that gap down on August 1st, immediately after the massive Treasury issuance in bonds. And we fell August, September, October. Beautiful. So I happened to go on a show like this in mid-July, July 17th, and I said, that's it, we're going to roll over. I've got some indicators on my intermarket little, voodoo that says we're going to start to roll over. We did. That was the trigger, though. I didn't have that trigger until I had that trigger. Anyway, we fell all the way down, right, from 4,600 to 4,100 right before. This is so important. This was Friday, October 27th. Now, if you follow me closely, you would know that there is a 16-week consecutive VIX crush on the Monday, every single Monday. And we literally had that. We had this VIX crush, and that's also into FOMC November 1st. November 1st, okay, after we've had this lovely 3-month pullback, was the FOMC intonated Fed pause. You love that word, where basically that also excited the bulls. So by nature, you have VIX suppression, you have the FOMC announcement that they're basically pausing, and then you have Yellen-Yahtzee comes out and doesn't issue the massive, bonds that are liquidity sucking. She actually kind of mixed it up and put in a whole bunch of bills and kicked the can down the road for the future Treasury issuance of heavy bonds to finance the fiscal spending. And long story short, that just, was the animal spirits erupted, and we had this massive short covering, biggest rally in 3 years.
Yeah. Well, I mean, everything you said is absolutely marvelous and have been totally accurate. I'm going to go a little more old school here. Todd knows this. I keep the Wall Street Journal every day, the highs and lows, and I've done that since about 1982. And I pulled out my 80s, 90s, 2000s file of the lows. In other words, where there was the lowest amount of new highs. And every one of those dates was a bottom of a market. And the date you were talking about on November 2nd was 5 new highs on the Wall Street Journal list and 1,865 new lows. So maybe you throw that into your matrix, because it has been deadly aggregate. Obviously, everyone who had to sell has sold.
Yes.
All the bears who put the bear position are already bearish. It hit all those oversold signals. And forget about the RSI stuff, but just the human beings. The people who are afraid got washed out. If you look, as I know you do, at the cash balances in the money market accounts and at the brokerage accounts, I think people can make a very strong case that the next leg of this bull market, and my number was like 4,600. Now I'm gonna be like Ed Yardini, Todd. I'm going to 4,800. Simply not because of any more short covering, but because of the cash. I mean, that's great to have 5% locked in for a year, but it's only for until they come down, and then you missed 20 or 25%. A, and then B, the other thing that I'd love to hear you look at, Samantha, or talk about.
Yeah, because I have a different perspective than that, so I want to weigh in when you're done.
Okay, well, my other point was, the other thing today was just everything that was crap was up 15%.
Yeah,
and micro craps were up 18%. SMHB, my favorite small cap index, for the last 2 days, has been up 25%.
Right.
So now all of a sudden we're getting breadth, and it feels to me, Samantha, like the market is actually sort of acting normal and saying that, well, the Magnificent Seven have made me a lot of money this year, but holy crying, I can buy a bank for 25% of its net asset value. I can buy, blah blah, and it seemed rational today. I don't know. Was I smoking something?
No, I think, let me just go back. The paid to wait mantra was something I had back in September of 2022, which means that you are paid to sit in money markets and T-bills, short duration, right? Because the interest that you can earn on your cash might be a safer bet than investing in stocks or bonds. Now, at the time, I didn't know that that we were going to have this global coordinated intervention by central banks in September and October. Remember the gilt blowout and the unprecedented, the largest, I should say, yen intervention by Bank of Japan, that also in 24 years, all of that kind of coalesced to put a bid of support in equities and bonds back in September, October. Remember, we were down below 3,600 SPX, very different market. Okay, so at the time, it was still a really good place to hold out and see where we were going to go. right? So that paid to wait was already in play. What you're talking about a little bit different, I have a perspective that's a little bit different, is that stocks are moving higher right now, not just because of the Yellen Yahtzee. She pushed out the issuance of bonds, and that does not mean we're going to have fewer of them to finance, right? It's that Q4 is going to have bigger issuance than Q3. Q1 of next year is going to be bigger than Q4 because the fiscal spending is still out of control. So we don't have our house in order, literally, right? So the risk isn't gone. But the reason why we have such strong follow through and everyone's now getting on the bull bandwagon is because the dollar has fallen.
Yeah,
so the dollar is major league as it relates to valuing stocks, right? So
particularly the international stocks. We've been saying that if Apple has $186 billion of cash in a 5% paying money market account, that essentially offsets the depreciation of the dollar or the conversion on dollars, and that it was going to hold up. If the dollar starts to really start coming down, which I totally agree with you, then those big multinationals get like 3 different headwinds.
But they were already getting paid, right, with their very large cash hoard. So this is just helping, because now the currency conversion for those who derive a lot of international revenue, it's just going to help very large cap plays. But the big picture to me is that this is the real macro tailwind for igniting the bulls. And then on top of that, you've got the short covering, and you've got the option gamma squeeze, which is basically this, kind of option market structure.
Say option gamma squeeze again, would you, Samantha? That's
no,
dead sexy.
I have to.
That's
it's the reason for the season. Market makers are the ones who actually have to hedge, and this is very, very important for why we have these directional moves of intensity. So at a point, though, they will start to peter out. And the CTAs, which are these price insensitive quants, they're also in the game, and they have to buy and sell at certain levels. So it was just a perfect storm for a bull run, but it was absolutely triggered, no doubt in my mind, on the falling value of the dollar and the softening in the 10-year yield, which, as you just mentioned, right, has gotten rejected and rolled over to 4.5. It hit almost 5% just a few weeks ago, right? So the fact that we've come back down strongly is also a nice tailwind for equities.
Okay, so we're still not at the level where we were, that what you mentioned, the July 31st, we have yet to clip that for the S&P 500. So we still have some room to move, but that's over the short term. What are your signals telling you, at least going into 24? Because a friend of the show, and I know a friend of yours as well, Jeffrey Hirsch, says is looking at an 8 to 12% advance in the S&P 500 for next year. What do you think because we already know how you feel for the rest of the year. What about for next year?
Well, first and foremost, we do have an hourly gap fill at 45.76. So that's definitely where we kind of rolled over on August 1st. Q's already filled that, Apple's 190. Yeah. The point is, we're really close to getting into those areas, and it's a dance, right? We've already run so hot into the hot sun that we probably have a little bit of exhaustion and digestion, and that would be healthy. But I'm still not, I know this is going to be kind of like, a little bit skittish here, but I'm not convinced that the falling dollar and yields is bullish for equities. So we have a situation right now where bonds have, stopped going down. The Bill Ackman, short cover is one thing, but I'm not a bond bull. I think this is basically, you get some squeezing going on. You get a nice, solid bounce. Whether or not equities come onto distribution with that bond bounce is really what we're waiting to see. In other words, risk parity is dead. So right now, bonds and stocks have been moving together, higher and lower, depending on the season. We've not really had any trust by bond bulls that we're going to go back to the old days of risk parity 60-40, where you have actually this kind of inverse relationship. That hasn't appeared yet. But I think we can have a bond bounce. I think we can have equities stay in this wide swath of volatility up and down. I don't see the falling dollar and falling yields as so bullish equities. I understand the motivation for what triggered this rally. I understand that it can go a little bit further for sure, especially with large cap because of, the currency advantage, let's say, and put it that way. And I also know that the economy is not falling apart. Wage inflation has helped delay recessions. So from an economic standpoint, we still have consumer spending, right? We still have inflation in our most valuable asset, our homes. We still have, a lot of intervention that comes in all the time whenever it looks like we're ready to go over the cliff in equities or bonds. But
I think she's being sarcastic. I'm not sure.
No, I'm not. But I don't see this as a bullish backdrop that all is well. Not at all. So I actually think that we can have a digestion with stocks and bonds as the dollar falls. And then this is very important. I know Jeffrey, by the way, mentioned last time about like the first few months of the year. If we don't go higher, it looks like, Biden won't be running again, something like that. It was a fabulous kind of analog in the past of presidential candidates and how the year for an incumbent starts off strong, assuming that the policies will stay the same. So I don't think we're going to have such a good Q1 in 2024. And then I think actually in about 6 months, we're going to see these yields that have softened. We're already from 5 down to 4.5, but I think we can, hit 4.3, 4.1. I think they're going to base and turn much higher. So here's going to be a shocker for you. And I did this just because
I'm all ears.
I knew you would like some.
I'm hanging on, Samantha.
Okay,
I'm on the edge of my seat, Samantha. Give it to us.
So last year in September of 2020, clients know this, Twitter knows this, the whole thing. I made a bet that the 10-year would hit 4.7% by the end of 2023. 1 year out, more than 1 year out. I basically, September 2022, and I said, this is what I see. We're going to hit 4.7 by the end of 2023. So we did. We took it out, right? We hit 4.99. Anyway, the point is, now that we're coming down, just like any other stock, you want to see it kind of backfill, digest. I think that sucker's going to hit 6.5 by the end of next year. So make hay while the sun shines. Make hay while the sun shines. I believe
that's breaking news.
You're making that call based on what it sounds like to me is that you're not really enthusiastic about the next 92 or the next $2 trillion that we need to raise to make up for the spending, shortfall, and that the Chinese are not buying the bonds, the Japanese have barfed up the bonds. There's not a lot of the huge players out there. Oh no, by the way, the Fed is not buying bonds. They were the largest marginal buyer to begin with, but now they're selling bonds in theory. I was going to ask you about quantitative tightening. Yes. I follow the Fed numbers every month. I don't see that. I don't see that they're buying that much net bonds when you take the issuance versus what they're buying.
Well, there are 3 parts of this. When for a while now, right, U.S. Treasuries had been shoved down the throats of banks. They haven't had a choice. So then obviously lots of unrealized losses from rising yields and all the risk premium that kind of builds into that as well, doing the job of the Fed, tightening, et cetera, all of that. Is kind of coming out, that the air is coming out of the balloon right now. So it's giving the animal spirits in equity bull and bond bulls hope. But that issuance, like you just said, it's not going away. It's building over time, and it has to be paid. But I think it's also a part of the rhythm of when the banks start to choke. Right, the intervention comes in, just like we've had recently, to give them a little respite. They also have that facility, right? The BTFP.
BTFP, yes.
Right, and then when that gets too big, so in other words, they have lots of programs that they can do to help. I'm talking about the Treasury, to help the banks and such kind of deal with this before they have to go in and buy again. And so right now, the fact that we definitely have falling foreign buyers, and Japan and China among them, we also have inflation that's getting stronger in Japan, and that is going to create potential disturbance in the force if they have to pivot, meaning remove negative rates. And that's going to obviously also kind of help that US dollar peak narrative that I've been talking about, with some rotation into yen. But I think that that's to be determined. And right now it's more of an intellectual discussion. There's talk about January, but there's a lot of threat ahead in who will absorb this Treasury issuance to fund fiscal. And inflation is really a problem, is really a fiscal problem. So even though we have this lovely, immaculate disinflation that's been in play this year, and that's what bulls love to see, right? This immaculate disinflation. I think we got maybe
it's immaculate, Samantha. I don't know. I don't buy immaculate. Okay. It's been pretty immaculate. It's been pretty immaculate from what I've been able to see.
Well, I think it's going to end. I think it, we have about 3 to 6 months, and I think that's going to end, and then we're going to start to move higher.
She's saying that the pixie dust is starting to end.
Yes.
Only dropped so much pixie dust, and then economic, gravity is the word I'm looking for.
There you go.
Takes over.
Yeah.
Okay.
Okay.
So I'm an editor, Samantha. So I take all these really long sentences and I put them into like 6 words. That's what I do.
Clear and concise.
Thank you.
Very good.
Todd, let's go. My head's going to explode. I want to talk about.
Let's leave it down on this block because I mean, obviously the 6.5% on the 10-year for next year is a big deal. It's breaking news. It's a buy, hold, sell exclusive.
Yeah,
so what else is Samantha going to say? Because we're going to leave it there on this block. But coming up after the break, we got to talk about sectors. We got to talk about the retail sales number that's coming out this week, how that's going to lead into consumer spending for the rest of the year. But we have a whole lot of stuff to get through, and I know Samantha's going to give us a whole bunch of breaking news stories for us as well. So we'll be right back after the break.
Give me an extra couple minutes. I need to get a massage before I come back. Okay.
Buy, hold, sell, brought to you by CrossCheck Management.
I mean, yeah, this time around, today when we go shopping.
Roll it down.
I am.
You don't need a car to listen to Sirius XM. You can listen anywhere. You know that, right?
What? Kevin Hart's Laugh Out Loud Radio.
Kevin, you could use your phone.
What?
Alexa, play Kevin Hart's Laugh Out Loud Radio on Sirius XM.
What?
This is how I know you're getting old. I guess that was it.
What?
Like the Kentucky Derby, Woodford Reserve Bourbon is a spectacle for the senses.
Welcome back to Buy, Hold, Sell. We have a very special guest with us today, Samantha LaDuc. She is the founder and president of LaDuc Trading. We welcome the audience to go to LaDucTrading.com, see what Samantha has to say, all the services that she offers. And Samantha, I had to put on my glasses. Everything you're saying is so intellectual, and it really is getting into the weeds of really dissecting this market and what we might be looking at next year. Your forecast for the 10-year yield at
6.5. That's all I heard. That's all I heard.
6.5% is just a monster number. So now let's start talking about individual sectors right now. One of the hottest sectors, obviously, is tech. We see the NASDAQ is already up 9.7% in the month of November and doesn't appear to be slowing down. Give us your forecast, because we talk about the Magnificent Seven a lot on this show. And but what's your forecast for the tech sector? Is this something that all investors should be taking a look at?
Can I share a chart?
Oh, yeah.
Okay, so let me just share this chart real quick, because you're bringing it up and I'm going to go and answer it live. See this particular chart right now?
Yes,
ma'am.
All right, that's the Mag 7. This is basically a formula where you just put all of the big Magnificent Seven, mega cap tech stocks together. Take a look. It's on a weekly time frame. You can see back here in October, November, where obviously we had a very large intervention where equities stopped going down, bonds too, and then we had a pullback. into the January effect, right, which was right here. You can see this kind of time frame.
Yep.
And then we had the bank bailout right here in March, loose monetary policy, by the way. NASDAQ loves loose monetary policy. And now you've kind of formed this wedge, right? So I literally posted this chart for clients on October 26th, and I said, bounce hard or trounce hard. Right here, this is literally 7 stocks, your MAG 7. They're going to do something, right? So they came down to support, and this is where they are as of today. Very, very strong breakout for 2 weeks and 2 days. So when you say, okay, let's take a look, we all know about the concentration risk since the January effect, since the March bailout. And of course, we just talked about the large moats, right? The monopolies, the safety bet. It's really a concentration risk bet because nothing else, quote unquote, is safe. Not treasuries for a while, right? Until just recently when yields started to soften, not value or small caps. Oh goodness, they're full of zombies. So you kind of look at this and you go, what is safe? Well, that's too easy. Like, unless
Come on, Samantha. It's been working for me for freaking 12 months.
Whatever. Well, it's too easy. And it's also, be careful, because it can also form what's called a fake breakout and a fast failure. So that's something to look for because they are so extended. They are so exhausted.
I hear fast failure and I think of high school, but keep going ahead.
So the fake breakout fast failure is just basically this exhaustion signal, which obviously hasn't triggered yet. We clearly are in melt up mode. And now, as you also mentioned, kind of, I don't know if it was on camera or off, but breadth is starting to expand again, which is a big honking deal. One of the reasons why I got very, very bearish in late July was July 17th, was because I could see that breadth was starting to peter out and roll over, and net buying versus selling, something that I track, was also starting to peter out and roll over. And then it did on August 1st. We just covered the reasons why, all kinds of reasons, plus the Fitch downgrade. That wasn't a warning like Moody's on Friday. That was a credit downgrade. The point is, it came together, and that was the trigger we were looking for, but they already smelled it. In other words, it was sold to you market up into that point. Right now, we've got a lot of incredible kind of like outlier charts, and not just the meme, what you were talking about, the oversold, we'll call them junk. I call it dash for trash, but that's called factor rotation. It's a hedge fund factor rotation, and it means that they are heavily long the VIP stocks and heavily short the junk, really the dash for trash. And when you start to see that come up off the bottom, it's short covering. So that's a sector rotation that had a really big debut back in July. So in June, we had a value rotation, which was basically that breadth started to expand, and it lasted for 2 months. So it kind of started with NVIDIA's earnings in May. Junior Tech got all excited. Then June, we had a value rotation for a month that turned into the hedge fund factor rotation in July, and then everything rolled right back over in August, right? So that's what's happening right now. We're having that kind of euphoric concentration risk in mega cap tech, and we're having some broadening out of the breadth, so that those meme stocks and other oversold, the Carvanas and the Wayfair and all the heavily indebted stuff that may or may not make it is also popping up like a daisy. So everything is bullish.
Okay.
Until it isn't.
And real quick, for the audience that's listening to the audio version of this episode, we definitely invite you to check out the television program of Buy, Hold, Sell, because Samantha's chart will be available on this show for that. Toby, what do you think about all of this? I mean, you're a big tech guy. You just looked at that chart. How are you feeling? You feeling bullish?
Well, I mean, I would say 3 things. First off is I'm not as smart as Samantha, so I'm going to go a little duller here. You have the AI beneficiaries. Yeah, look at the size of his head. I know, but half of it, the alcohol is just turned into mush. The massive AI beneficiaries, to me, as an old mutual fund manager, was the safety trade. I could come up with 12 reasons why I wanted to own, the Magnificent Seven plus. Like, matter of fact, Jeff Hirsch had this stock before I did, but SMCI, which is essentially has a supercomputer chassis that are all filled with NVIDIAs. We bought it $150. I sold 4,000 shares today at $300 on the nose. And what I'm saying is that the market within the market is if people actually know what the F they are doing about AI and understand how actually a data center works and what chips you have to have in it and what type of fiber optics you have to have in it, it would make sense that if you take the net spending on data centers over the next 6 to 12 months, which is up 21% over the year before, that spending is going to go into SMCI, Marvell Technology, Palo Alto Software, Aristanet, all of those stocks, Samantha, if you put them on a chart, you will see that they have pulled back. We waited for them to pull back again to add. They pulled back classically to their 50-day on higher than average volume. Then it pooped out. The sellers ran away. The FOMO chasers, got their heads bashed in and said, I'm never going to buy a stock again, which is one of my favorite days of the year. And then the real buyers who actually understand what the F they're doing are saying, on a forward basis, SMCI is selling at an 18 PE and it's going to grow its earnings 54% a year for the next 2 years, guaranteed, unless there's a tsunami that takes over the entire world. So to me, there was a lot of rational buying in the spaces where I'm an inflection transformative investor. What we do is we look for transformational change and the inflection point of where it takes off and where supply demand exceeds it. I'll give you another example. When the Panama Canal closed, and all of a sudden now you can get 20 ships through there. Well, guess what? Half the world operates on liquefied petroleum gas, LPG.
Mm-hmm.
We were buying LPG tankers, the very, very large ones like Cray. Those stocks are all up 150% for us. They're paying 30% dividends. So my point is, yeah, macro, yada, 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 yada. But there are significant opportunities. And now, I'm looking at regional banks, the selling for 25% of their net asset value. I'm not a value buyer, but I'm an opportunistic buyer. And if the market narrative is that interest rates are going to be cut next year, we bought a stock yesterday called Alexander Real Estate. The ticker symbol is ARE. Nobody understands what the F these guys do. What they do is they build specialized buildings for biotech companies. We're a big bio and tech investor, and one of my private clients is one of their biggest tenants, right? The stock got down to 2 times cash flow. They don't have any variable debt, and the stock's been up 28% in the last 2 days. My point is, when the narrative changes on interest rates, if you look at the bottom of the barrel, regional banks, the REITs that have been blown up, obviously the Russell 2000, but particularly this SMHB, which is a leverage, we've made, 50, 60% returns in weeks. And it's just that you never heard of any of these stocks. But the opportunity is available to everybody if you believe, as I believe, which good, we have a bull bear on rates, that regardless, here's my argument against your monetary theory deal. If, and I go back to my philosophy classes, if the Fed has been essentially flooding the market with free money for all this time, and we still had no inflation, why is that? And the answer I come up with is because there was as much disinflation as there was in monetary inflation. And it wasn't until we got into the crazy of the 2020, everybody gets a check and $7 trillion of stimulation. That money hasn't gone away. It's still in the system. So my monetarist perspective, without a PhD, I would like to say, is that until that money comes out of the system, it's got to go somewhere. It went into 5% bonds over the last 3 to 4 months. And now all that money, all of a sudden, people say, hey, honey, how come my brother-in-law's freaking LPG stocks and his SMCI, how come those stocks are up like freaking 40% and we're only getting 5%? And that to me is the deal. Now, if you're right on your 6.5%, then I'm going to have very tight short stops on anything that has to do with a bank or a real estate investment trust, but even, or the utilities, for Christ's sake.
Okay.
Florida Power
Yeah.
and Light, now, NWE.
Yeah.
Well, let's parse this out. The BTFP, which is where obviously banks are hiding out so they can kind of navigate,
Yeah.
and other such facilities, if you're so confident that, inflation isn't a fiscal problem, then those facilities shouldn't exist. They should just, have the law of natural consequences and obviously the fiscal spending, but we don't, right? So we still have to somehow keep the markets from falling and keep the economy from falling, and all of it to me is a moot point right now because they keep coming in and showing their hand. They don't dare have price discovery. So that doesn't mean there aren't some fabulous value plays out there. I do the same thing. I run a long only portfolio in addition to the swing, in addition to the chase timeframes.
Yeah.
And again, just to kind of clarify the chase stuff, because I run a live trading room, for do it yourself, mostly active traders and investors, they ask questions about, market direction and sector rotation and stock selection. And then I obviously have my own trade setups that I share, chase, swing, and trend. But the trend stuff is long only, right? So this is there's a macro backdrop and sector rotation that comes into picking some of this stuff, like oil as an inflation hedge, back in late 2020. I still have those fabulous, energy plays. Uranium also was included with that.
Yeah, we're big uranium players, but again,
Correct.
to me, that's a supply demand issue.
Well, it is a theme, though, that I've had, since fall of 2020. So those aren't going away, but they've started, especially in the oil and gas space, right, to kind of digest, for lack of a better word. And there are other building materials is a fabulous sector. There's some really, really great spots in there. Medical distribution also has been phenomenal performer for us for the past 2-3 years. I have a whole list of portfolio positions that are doing really, really well, and none of them are Bitcoin or tech.
Okay.
Well,
Wow.
I would say this, the other thing that I noticed today. So we had some buy stops on some home builders, because again, the thesis was, well, if interest rates are coming down, then it's going to help the home builders. Well, the biggest stock we had today that moved was Builder, BLDR, which owns
love that one.
The stuff that goes into a house.
Yeah.
So I look at it, if 6.5 is correct, and what's your time frame? Is that like January, February, Samantha?
By the end of next year.
Oh, end of next year. Okay, well, forget about that. I don't care about that. I thought you were saying it was like January of 2024. Well,
yeah, no, this is a year. In other words, I made the bet in September of 2022 that we would reach 4.7 by the end of 2023. Check. Now I have to make my new prediction. This is the year. This is the time frame, right? That you make the new predictions. So mine is 6.5 by the end of 2024.
All right, Todd, we'll put her down for whatever that day is in 2024.
Yes, we will. So before we close out the show, I want to touch on retail sales. We have the retail sales data that's coming out for the month of October. Last month, we saw an upside surprise due to back to school. Shopping season was robust. What's your take on the consumer? Do you think the consumer is going to continue to spend money going into the holiday shopping season? And what does this translate to some of the retail stocks that are out there?
All right. So first, let me just pull back a little bit and do a little bit of the macro shtick, right? Because that's always going to be my backdrop. And then I'll go and look at the sector and then the individual stocks. So from a macro standpoint, I had a big thesis that wage inflation delayed recession. So it is very much that the first 2 years, 2020 and 2021, the inflation absolutely beat out the gains in wage inflation. Then we kind of played a nice game of catch up. So we actually got through kind of the meat of that big headline CPI, right, of 9.1% in June. And anyway, so wage inflation started to compete and, if you will, not only outperform productivity, but also outrun the inflation as inflation was decelerating from the headline, which was very, very helpful for consumer spending. So that's been in play for 2022, 2023. So that's one of the reasons why the recession callers didn't unfortunately prove correct, is because it was just
unfortunately. Samantha, what
okay,
are you
no,
for
them, no. For them, unfortunately, but my point is,
okay, I was confused.
Yeah, no. So nominal GDP has been
Damn it, we
growing.
didn't have a recession. Jeez.
No, we didn't. We don't have one. Nominal GDP had been growing, but that's mostly government spending. So real GDP, however, is flat. PMIs are still flat. GDI, gross domestic income, is flat. So we don't really have a robust economic engine at work here, but we definitely had consumer spending because wage inflation has absolutely outpaced inflation. That's been very, very helpful. I think you can see now, right, all kinds of negotiated union wages and strikes that have succeeded. And those input costs are going to stick around for a while. Companies have done a good job in earnings, by the way, of passing higher prices along, and they've been absorbed because they're maintaining margins nicely, but it's on declining revenue. So far, earnings have proven that they are beating, they usually do. The bar is always, low. But the point is they are beating by having such tight control over profit margins, but they're beating on declining revenue. Investors want to see, higher revenue and good earnings and good margins. So I think that's going to start to get challenged again in the first part of next year. It's just part of the cycle or end of cycle that I think we're going to start to see companies starting to buckle, the higher costs of financing, which is going to be a big thing, by the way, in 2024, because so many companies,
especially if we have a 6.5% Fed rate.
100%, and especially as they have, done so much of their refinancing on the bottom of 2020, that's got to start to kick up. They got to start to refinance.
Well, Todd, if you looked at the data today, again, I'm going to go a little bit shorter sentences with less consonants and stuff. The reason why core inflation was down it was flat. The other PCE inflation was down because of gasoline prices and used car prices
and fuel, just across the board.
Gasoline
Oil,
is fuel.
gas.
I don't know about up there in Massachusetts, but down here, gasoline's fuel. And at the marginal buyer level, marginal household, if they're saving $200 a month on gas, and that means their heating costs are down, so on and so forth, they have extra money. But we left out the part about the fact that we had the world record in the last 3 months of new money going on credit cards, and so I'd agree with Samantha in saying that this thing will come to an end in terms of peak. But who wants to be in retail stocks, Todd? You're like the craziest guy I've ever seen. All you do is ask about Target and be Walmart. You want to
I'll tell you, I have three.
Okay,
retail
give us
stocks.
three. Give us three, Samantha.
Okay, so I have two that are on my trend long only: Walmart and BJ's. So Costco's actually, it was a swing long. I took it off. I regret that I took it off. But the point is, there's a time where money kind of goes sideways, it's dead money, and then technically it can break out of patterns. Costco was a great swing. I know Munger's crazy about it and a few others, but the point is I really liked its cousin BJ's, and I have for years, and I also have Walmart. So those are the only, and TJ Maxx. Oh my God, I forgot that because I cut Costco. Those three are it. Those are the only retail that I have.
Okay, well, and also it's a timely topic. Not just because the retail sales data is coming out, but everybody's talking about what the consumer is going to be like, the health of the consumer as we go into the Christmas season, and so everybody wants to know: will we see the robust spending that we have seen? Yeah. And you are right, Toby. So many people are actually borrowing on their credit cards, but they continue to spend.
Well, I just, my Todd, as you know. What I hate is the term "the consumer," as if it's some aggregate of the consumer is the top 25% of the households who have 78% of the discretionary spending. I don't care about anybody else other than the top 25% because there's an order of magnitude more discretionary spending than the bottom 50%. It's just like the bottom 50% owns 5% of the wealth in the world. The top 20% owns 72% of the wealth. I mean, so I don't care about the consumer. I care about the upper 25 percentile. And the upper 25 percentile, we are spending our asses off.
Well, the consumer is our audience, and I want to cater to the consumer.
No, the consumer is...
your audience are boomers, and they're absolutely the ones that are spending.
Absolutely.
The millennials are not, and they're absolutely the ones accruing massive amounts of credit card debt at incredibly high rates. So
Well, the only boomer in this trio right now is Toby, and we all.
I'm just
Anyway.
saying, it's going to be very interesting. There's AAA does this thing about the price of gasoline average, and then there's somebody else takes that data and creates it into a retail sales forecast. It's very highly correlated that retail sales in the aggregate go up when gasoline prices come down. I mean, that's shocking, right? But we're still a 73% service economy. So I follow much more service spending than I do on buying tchotchke shit you don't need at your house. And you know, that's sort of, that doesn't count. What I'm trying to say is there's only like 12 factors in the whole economy that count, Todd. Everything else is just noise, and it gives CNBC something to talk about. But yeah, they're meaningless when you're trying to forecast macro, in my opinion.
Okay, so no tchotchkes for Christmas for Toby. I mean, I'm going to make a note.
And
of
they're
that.
also not hiring a lot of workers. I mean, Amazon already had. Walmart announced they're not putting in additional workers.
200,000 people, right? Exactly.
So I'm not excited about the season, honestly, but I think that as you just delineated, there are two groups, very, very bifurcated groups. The boomers who are spending hand over fist because they've got it. Again, they're earning, interest on their cash, and the millennials who are very frustrated on the affordability of autos and homes and.
Yeah.
I just had a subscriber who is becoming managed account. We'll end it at this. He's a boomer. He's getting ready to retire. He's going to be 70 in like January. And he sends me his broker statement, financial statement. And he says, Toby, I'm really worried. I don't know if I'm going to be able to get by. I've got 1.7 million in one IRA and then another 1.2 million in another IRA. Plus, I said, will I be able to get by on $3 million? I said, you know that the average yield in our income portfolio right now is about 11 and 12%. If you can't get by on 250 grand a year, then you got to cut your, I don't know, about where do you live in Manhattan?
Can you tell that to Congress?
Yeah.
I'm serious. How about we tell them to live within their means? Because that's the biggest issue. So
yeah. All right, well, that's a subject for a whole different matter. So
we'll have that show later on.
We'll have that show later on. When does the Congress get off the crack pipe?
There you go.
Okay.
But we'll talk about that another time, though. That's for sure. So Samantha, everybody can follow you or go to LaDucTrading.com. But what's your Twitter handle? Because I know you're very active on there.
At Samantha LaDuc, LaDuc. So yeah, either place, happy to engage. I'm very happy to meet you, gentlemen. And I had not heard of you before. And it was kind of nice that Jeffrey was the trailblazer here. So I could get this invite and talk shop, macro to micro, sector rotation. I don't know what retail sales are going to do.
Well, that's dead sexy. Sector rotation. I
know that you're going to be on top of it. Whatever it is, whatever it comes out to be, you're going to be talking about the hottest print of the day and the stocks that you want to have into the year end. But for right now, I would say just be careful. It's a little exhausted. And the Santa might have come a little bit early.
Oh my goodness gracious.
Right.
Well, we will find out, that's for sure. So Samantha, thank you again for joining us today on Buy, Hold, Sell. Brilliant analysis. That's all I can say. I
Thank you,
definitely one of
gentlemen.
the smarter guests that we've ever had on this show. So this is great. And we will have you back. That's for sure. Especially when we get
Samantha, Todd is exhausted. I don't know if you can tell this, but he was processing everything you've said. And now he's going to go take a cold bath.
Well, I'm going to go write my client post because this is what I do every afternoon is summarize everything that's going on in the market and get it out there for them so they can actively trade it. I wish you gentlemen a great rest of the week.
Email so we can get a copy.
I will.
Absolutely
Cheers.
will. So that's fantastic. So on behalf of Samantha LaDuc and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.
I want you to smash that like button.